Have you ever wondered how the stock market works? Well, let's unravel this mystery together. The stock market, at its core, is a bustling marketplace where shares of publicly held companies are traded. It's like a grand bazaar for buyers and sellers. Now, what are shares, you ask? They're simply pieces of a company that you can own. When you buy a share, you essentially become a part owner of that company. So, in essence, the stock market is a marketplace for buyers and sellers to trade shares of publicly held companies. Now, you might be thinking, how does one buy or sell shares in the stock market? Well, it's a process that involves a few key players and principles. To buy or sell shares, you need a broker. A broker is a person or company that is licensed to buy and sell stocks through the exchange. They act as the middleman between you and the market. So you might be wondering, how do you choose a broker? It's essential to select a broker who is reliable, transparent, and offers a user-friendly platform. It's also important to consider the broker's fees and the services they provide. Some brokers offer research and advice, while others just provide a platform for trading. Once you've selected a broker and set up your trading account, you're ready to start buying and selling shares. But how are the prices of these shares determined? This is where supply and demand come into play. If more people want to buy a stock, demand, then sell it, supply, then the price moves up. Conversely, if more people wanted to sell a stock than buy it, the price would fall. In the stock market, prices are constantly changing. They can fluctuate based on economic news, company earnings reports, geopolitical events, and many other factors. Remember, the price of a share is determined by the market and it can fluctuate throughout the day. Have you heard of the Sensex or the Nifty? These are called stock market indices. Now, what exactly are these indices? Well, imagine them as a thermometer for the stock market. They give us a snapshot of the overall market health by tracking the performance of a specific group of stocks. Let's take the Sensex, for instance. Short for the sensitive index, it represents the top 30 traded companies of the Bombay Stock Exchange. Similarly, the Nifty or the National 50 represents the top 50 companies on the National Stock Exchange. These indices help investors gauge market trends and compare individual stock performance against the broader market. In essence, stock market indices are vital navigational tools in the vast sea of investing. They provide a compass guiding investors toward informed decisions. So, the next time you hear about the Sensex or the Nifty going up or down, you'll know what it means. Investing in the stock market isn't without its risks, but with risk comes potential reward. When you buy a share of a company, you're essentially buying a piece of that business. This means you're directly impacted by the company's financial performance. If the company does well, your investment may increase in value, providing you with what's known as capital gains. On the other hand, if the company struggles, your investment could decrease in value, leading to potential losses. Now, it's important to remember that stock prices can be influenced by a multitude of factors, including economic indicators, political events, and market sentiment. This can cause stock prices to fluctuate, sometimes quite dramatically, which adds an element of volatility and risk to your investment. In addition to capital gains, investing in the stock market can also provide you with dividends. Dividends are a portion of a company's profits that are distributed to shareholders, typically on a regular basis. This can provide a steady income stream, especially if you're invested in well-established companies that regularly pay out dividends. However, not all companies pay dividends, especially those in growth phases. They may prefer to reinvest their profits back into the business to fuel further growth. Therefore, it's crucial to research and understand a company's dividend policy before investing. Navigating the stock market can sometimes feel like sailing through stormy seas. It's unpredictable and can be risky, but with thorough research and informed decision-making, it's possible to chart a course towards potential rewards. It's also worth considering diversification, spreading your investments across a variety of sectors, industries, and companies. This can help to manage risk, as poor performance in one area may be offset by strong performance in another. Remember, investing in the stock market is not a get-rich-quick scheme. It requires patience, discipline, and a sound understanding of market fundamentals. So while the stock market does provide opportunities for wealth creation, it's not without its challenges. It's essential to approach it with a clear understanding of both the potential risks and rewards. The stock market offers a chance for substantial financial gains, but it's important to understand the risks involved. So that's a quick run-through of the basic workings of the stock market. We've unpacked the concept of the stock market, explored the mechanics of buying and selling shares, and highlighted the significance of stock market indices. We've also touched on the balance of risks and rewards that come with investing. Remember, knowledge is power. The more you understand about the stock market, the better equipped you'll be to make smart investment decisions. Happy investing!